Welcome to Trader TV Fixed Income, your insight into the trading climate for professional bond investors. I'm Dan Barnes. When markets get volatile, bond dealers have traditionally relied on voice trading to make sure they can secure a price. However, that is changing. We're speaking with Carl James, Head of Fixed Income Trading at Pictet Asset Management from the FIX conference in London, to get the buy-side view of electronic bond trading evolution. Carl, welcome to Trader TV.
Thank you very much.
Why do traders turn to voice when markets tend to get choppy?
Historically, traders have been used to executing over phone, so there's a little element of muscle memory in there. The other element is the search for liquidity. So it's about finding the best place to execute the business. It could be as hard as finding that bond. It's not even, I've got these choices, there might not be a choice. Now, as the technology on trading desks is still at an early stage within fixed income, that when markets are volatile and liquidity dries up, then actually you revert to the muscle memory, which is about relationships. And what you're able to do is phone up and say, you're representing a particular asset management house and your own personal brand as well, because that still carries some weight as well. Rather than if you just send an electronic message, it's come from this firm, and the trade of the other side has no context around it.
And is electronic trading becoming more reliable in volatile markets?
It's more reliable in the sense of there are more choices. It's more reliable because the people providing liquidity are now more used to providing that liquidity. And don't forget, there are different methodologies of execution. So you might have the RFQ model, you might have the central limit order book model, or the synthetic central limit order book model, or you might have the dark pool model. So there are different elements to it, not only the methodology, but the instrument as well. So broadly, I'd say yes, it's becoming more reliable, but it depends.
Okay. And is pricing data becoming more reliable to enable electronic trading in any particular instrument classes?
So the pricing data, which I think you're talking about is historic pricing data, is becoming better in the more liquid part of the market.
Okay.
So if you're in the sort of the rates area, then yes, there's enough data for you to make some sensible, more informed choices. But as soon as you start to move outside of that into the much less liquid area, let's say high yield, there are parts of the data that you can pick up on, but it's not as perfect or as good as in the rates area.
And does that have an impact on your ability to actually measure execution quality?
When you speak about stressed markets, that's a different space to be in. So the data you've picked up over, say, the last 6 months or 1 year, and then you have a really volatile day, that information might be utterly useless to you, but it might give you a guide. And that's why I think that the data-driven trading, I think, is becoming more and more important. However, relationships with your executing counterparts is really important as well, because they need to be confident that you have a credible model to engage with them. You're not going to run them over. It is about having that long-term relationships. So at Pictet Asset Management, what we do is we do reviews with our top counterparts, and we go through the data with them. I do a live presentation on Tableau, as it happens, and we demonstrate where they sit, where the hotspots are. Now, that to me is actually part of best execution, because you are absolutely giving feedback to the broker, and you're able to sort of say where they need to do better, etc. So that is actually part of best execution for me.
Okay, and that's interesting. That takes us to the actual end investor. Clearly, there are two outcomes the end investor needs to have. One is to see that best execution is fulfilled, and the other is potentially the impact on the actual investment returns themselves. Do you think the way that trading is managed, does that have an impact on investment returns directly?
There's a spectrum of what buy-side desks are able to do.
Yeah.
At one end of the spectrum, you have a processing unit.
Mm-hmm.
It's literally, it could be a sausage factory.
Yeah.
You are literally processing the orders. I personally don't adhere to that. However, some models that might be useful because actually it is about getting the trades done, moving on. When we meet with clients, I think it's important for us to say, yes, we can evidence best execution. Now, frankly, for me, I think that's your base level. Of course you do best execution.
Yeah.
It's actually beyond that. What is it that the dealers do? What is their role within engaging in the investment process? The better that you execute, the more efficiently you execute, the more returns that you'll get for your underlying client. So we do a number of engagements, whether it's educational or whether it's actually just purely having client meetings, and we walk through our technology, we talk through our people, we talk through our processes, and it's highlighting the really good work that we do.
That's fantastic. Carl, thank you so much.
Thank you very much.
I'd like to thank Carl James of Pictet Asset Management, and of course you for watching. To catch our monthly reports on other markets or to subscribe to our newsletter, go to tradertv.net.